There are many purposes of accounting, with many types of income and expenditure that will affect accounting. The purposes of accounting are recording transactions, managing the business through planning, monitoring, and controlling, ensuring compliance to prevent fraud and follow laws and regulations, measuring performance, and providing control to assist with the prevention of fraud and the management of trade receivables and trade payables. Recording transactions is supported by accounting because it provides a clear and accurate record of all financial activity to ensure reliability in future decisions. Managing the business through planning, monitoring, and controlling is supported by accounting because financial information allows managers to plan effectively, track progress, and take corrective action. Compliance is supported by accounting because proper financial records ensure the business follows legal requirements and reduces the risk of fraud. Measuring performance is supported by accounting because it allows the business to compare results over time and assess whether financial objectives are being met. Control is supported by accounting because it helps identify discrepancies, monitor money owed by customers, and ensure payments to suppliers are made correctly to reduce fraud risks. The different forms of income are capital income and revenue income. Capital income is money invested into the business over a long period to purchase non-current assets. The different types of capital income are loans, mortgages, shares, owner's capital, and debentures. A loan is capital income because it is borrowed money from a bank or financial institution that must be repaid with interest over time. A mortgage is capital income because it is a long-term secured loan used to purchase property, where the property acts as collateral. Shares are capital income because they provide funds from investors in exchange for ownership and possible dividends. Owner's capital is capital income because it is the money invested directly by the owner to start or grow the business. Debentures are capital income because they are long-term loans issued by the business to investors with the promise of fixed interest payments. Revenue income is money received through the day-to-day operations of the business. The different types of revenue income are cash sales, credit sales, rent received, commission received, interest received, and discount received. Cash sales are revenue income because they are payments received immediately from customers for goods or services. Credit sales are revenue income because they are sales made where payment is received at a later date. Rent received is revenue income because it is money earned from allowing others to use business property. Commission received is revenue income because it is payment earned for completing a transaction on behalf of another party. Interest received is revenue income because it is money earned from savings or lending activities. Discount received is revenue income because it is a reduction in the amount payable to suppliers, increasing the business's income. The different forms of income are capital income and revenue income. The different forms of expenditure are capital expenditure and revenue expenditure. Capital expenditure is money spent by a business to acquire, upgrade, or maintain non-current assets that will be used for more than 1 year. Current assets and non-current assets are categories of resources a business owns where current assets are expected to be converted into cash within a year, and non-current assets are long-term resources used over several years. Tangible assets and intangible assets are types of non-current assets, where tangible assets have a physical presence such as machinery or buildings, and intangible assets have no physical substance such as patents or trademarks. The different types of capital expenditure are non-current assets that are either tangible, such as land, buildings and premises, machinery and equipment, vehicles, fixtures and fittings, or intangible, such as goodwill, patents, trademarks, and brand names. Land is capital expenditure because it is a long-term tangible asset purchased to support business operations. Buildings and premises are capital expenditure because they provide the physical space where the business operates. Machinery and equipment are capital expenditure because they are used to produce goods or deliver services over many years. Vehicles are capital expenditure because they are used for business transport and deliveries over the long term. Fixtures and fittings are capital expenditure because they improve or equip the premises to support business activities. Goodwill is capital expenditure because it represents the value of the business reputation or customer loyalty acquired when purchasing another business. Patents are capital expenditure because they give the business exclusive rights to produce and sell an invention for a set period. Trademarks are capital expenditure because they legally protect the brand identity of the business. Brand names are capital expenditure because they are purchased to increase brand recognition and customer trust over time. Revenue expenditure is money spent on the day-to-day running of the business to maintain operations. The different types of revenue expenditure are inventory, rent, rates, heating and lighting, water, insurance, administration, telephone, postage, stationery, salaries, wages, marketing, bank charges, interest paid, straight line depreciation, reducing balance depreciation, and discount allowed. Inventory is revenue expenditure because it is the cost of goods bought for resale. Rent is revenue expenditure because it is a regular payment for the use of property. Rates are revenue expenditure because they are local taxes paid on business premises. Heating and lighting are revenue expenditure because they cover essential utility costs for business operations. Water is revenue expenditure because it is a recurring cost necessary for the premises. Insurance is revenue expenditure because it protects the business against risks and must be renewed regularly. Administration is revenue expenditure because it covers the cost of running the office and support functions. Telephone is revenue expenditure because it relates to communication services used daily. Postage is revenue expenditure because it includes the cost of sending mail and packages. Stationery is revenue expenditure because it is regularly used for office tasks. Salaries are revenue expenditure because they are fixed payments to employees. Wages are revenue expenditure because they are payments made to staff based on hours worked or output. Marketing is revenue expenditure because it promotes the business and drives sales in the short term. Bank charges are revenue expenditure because they are fees for banking services. Interest paid is revenue expenditure because it is the cost of borrowing money. Straight line depreciation is revenue expenditure because it spreads the cost of an asset evenly over its useful life. Reducing balance depreciation is revenue expenditure because it allocates more of the asset's cost in the earlier years of use. Discount allowed is revenue expenditure because it is a reduction in the selling price to encourage prompt payment by customers. Thank you for watching this video on understanding the purpose of accounting. I'll see you in the next one.